With so many mixed messages, who do you ask for advice about the property market? 2 lessons from one of my mentors, Jim Rohn, and Ken Race answers a listener's question about claiming negative gearing in a trust. That's what we're going to discuss today.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
Welcome to episode 11 of the Michael Yardney podcast. If you're a new listener, welcome. And if you enjoyed, why not go back through the archives on iTunes or Stitcher or on our website, michaelyardneypodcast.com. And there's lots to learn. And if you're an established listener, thank you so much for helping us rank as the #1 property podcast on iTunes. Now, I'm very excited about the show today, not because of the show, because I've just come back from visiting my daughter, Lisa, who's had her 3rd child, and that's Pam and my 10th grandchild. So it's been an exciting weekend and just reminds us the importance of life. Actually, I'm also excited about the contents of the show because I'm answering 2 listeners' questions. The first one is about who you ask for property investment advice. There are so many mixed messages and so many vested interests, so I think that's a great question to answer. I'm also going to share with you some messages from one of my mentors, Jim Rohn, that you're going to get a lot of benefit from as you listen to my Mindset Moment. And then afterwards, my guest today, Ken Race, Director of Metropole Wealth Advisory, is going to answer another listener's question about can you claim negative gearing in a trust when you own a property in a trust. Lots to cover, so let's get on with the show. Who do you ask for investment advice? Now, that's a good question, and it was asked of me by Rob Maguire from Randwick in New South Wales. Rob, thank you for sending in the question, and of course, any question that I answer on the podcast gets a gift as a way of saying thank you, so expect your book in the mail. And your question related to all the mixed messages you're getting in your inbox and on the magazines, and you wondered, well, who should you ask for advice? Thank you, because it's a great question. So let's have a look at the various alternatives and who you could turn to. And the first option is no one. I found, in fact, many beginning investors think they understand real estate because they've lived in a house or they've rented one, and that's a big, big mistake. So they don't ask anyone for advice. I guess that's the reason why 50% of first-time investors sell up within 5 years, and 92% of investors never get past their second investment property. The second group of people you could ask are your friends or your family, and I'd understand why you do this, but the question is, are they financial experts? How many millionaires do you have in your family? Because if they're not financial experts, don't ask them, because their advice is likely to be to avoid investment properties because of the risk, or it'll be emotional advice, not sound advice. Another group of people ask are real estate agents, but remember, estate agents work for the vendor. It's their job to sell the property at the highest price, and they're unlikely to tell you about other good properties in the area that they're not selling. And of course, my team, a lot of them are licensed estate agents. In fact, I'm a licensed estate agent. But can I tell you, most estate agents don't own any investment properties. Okay, another person you could ask, and I know a lot of people do, is ask their mortgage brokers. And while it's really important to have an investment-savvy mortgage broker on your side, particularly at the moment with all the changes and difficulties of getting finance, they may not understand the property market well enough to advise you on what's an investment-grade property. Now, if you don't understand what an investment-grade property is, go back to podcast episode number 1. You'll find it at michaelyardneypodcast.com or, of course, on iTunes. And I hope you subscribe at both. Subscribe at iTunes so you get it automatically on your phone. And go to michaelyardneypodcast.com and subscribe, because I send a lot of information out in between the podcasts. Anyway, the point I was making was that you should only be buying investment-grade properties. I've explained that exactly what it is in Michael Yardney podcast episode number 1. But most mortgage brokers are not the right people to tell you what that is. Of course, you could ask an accountant, and your accountant should be advising you on tax matters and structuring, but most accountants don't have an intimate knowledge of the property market required to give good investment advice. You're saying, well, I'll go to a financial planner. Well, financial planners are licensed to sell financial products, but interestingly, most aren't able to advise on real estate. Now, I bet some of you didn't know that. Now, this may be because they don't have a sound knowledge of property, but it's in general related to their license and the company they work for not allowing them to. Now, Metropole Wealth Advisory, one of the companies in our group that Ken Race is the director of, is a financial planning company and has a financial planning license, and Ken is an accountant. And he's one of those rare breeds who actually is allowed to, because of our license, give property advice, and a rare accountant who understands things. So if you're interested in getting proper financial advice, you just got to see the right financial planner, somebody who is able to recommend properties, but not something just off their stock list, because most financial planners who do sell property or do recommend property work with property marketers who sell off a stock list, and that's not investment grade property. Of course, that's the other person you could ask, but I wouldn't, and that's the property marketers, because they're salespeople, and they may seem to be on your side, but they're really selling a product for a property developer who's most likely going to make the biggest profit out of the whole deal. So never see anybody who's actually got a list of properties to sell you. You should be seeing somebody who's going to be independent. Now, another place you could get advice or information from would be from investment seminars and workshops. Ask yourself, though, is this person conducting the event, is he an investment expert in their field? Now, quick disclaimer, I do give seminars, but I've never sold properties at those seminars. In fact, I've never sold properties in my life. So what you've really got to do, though, is learn. If you're going to hear somebody at a seminar, if you've got to learn from them, have they been financially secure from investment or from selling seats at their seminars? Okay, then back to the original question, who do you ask for advice? There seems to be an abundance of property mentors out there at the moment, somebody who's going to give you guidance. Now, I've already spoken in previous podcasts about the importance of mentors, but the trick is with property, many people who are portraying themselves as mentors are actually really property sellers or marketers in disguise. Now, don't get me wrong, I believe it's important to have mentors. They see your blind spots, they give you guidance, they support you, they expand the way you think. I have mentors. I run a mentorship program. You can find out all about that at michaelyardney.com.au, where I run a 12-month mentorship program. Just be careful who you choose and ensure they've already achieved the same results you want to. Okay, so back to the question, who do you ask for investment advice? Now this is getting complicated. I've told you everyone you shouldn't. Maybe you should choose a buyer's agent, and they can be a great help in selecting the right property, but they usually just order takers. They don't devise a plan that takes into account your family's future and your risk profile. If you think about it, if you go to a buyer's agent, and I know there's some really good ones around, in fact, a lot of my team are buyer's agents, but if you went to a buyer's agent in Perth over the last couple of years, they would have only recommended Perth because that's where they work, that's where they make their money. They're not going to tell you to buy in Sydney or Melbourne. And that's why you need to go above a buyer's agent. Yes, a buyer's agent may execute the deal and do the work, but I believe you need a property advisor or a property strategist. In my mind, it's critical to have a trusted advisor when making property investment decisions. It's just too hard to make them on your own, and it's not fair to try and do it by trial and error. There's a huge learning fee involved of time, of money, of effort, of heartache. I find it interesting that most wealthy people have and are prepared to pay for trusted advisors in all areas of their lives, while the average person doesn't have any advisors. Or they take advice from salespeople that they perceive to be advisors, but are really far from independent. On the other hand, following the teachings and proven systems of those who've already achieved what you want to achieve, who've retained their wealth through a number of property cycles, it won't necessarily guarantee your success, but it's going to make it much, much more likely. So, Rob, thank you for that great question. It's opened up a whole discussion on how to choose a trusted advisor. Oh, look, maybe I should just say one more thing. How can you tell that you are dealing with a trusted advisor? In my mind, a trusted advisor tailors their recommendation to your personal circumstances, and they warn you of the risks as well as the rewards. Their advice isn't biased. Don't have products or properties to sell or services to be sold. So one of the first questions you've got to ask them is, how are you getting paid? How are you getting paid? Because this is going to reveal a lot. If they're offering their services or their advice for free, they're going to get paid by a third party, such as the developer or property seller. Then their advice can't be independent. Your advisor should be qualified and a member of a recognised organisation such as PIPA, the Property Investment Professionals of Australia, and they should be an investor themselves. They should have a thorough understanding not just of property, but of finance, of economics, of the tax system as it relates to property investment. Similarly, your advisor should have no properties for sale. They should have a number of investment options available to you depending upon your circumstances. And they shouldn't make any recommendations without seeing you, and they definitely shouldn't create a sense of urgency. So the bottom line is there's only so much you can learn from the financial media, from books, from seminars. And while you can gain knowledge from the internet, what you can't gain is experience. That takes years to acquire and it comes at a cost. It's just too difficult for beginners, and in fact in this market for most experienced investors, to gain the perspective into what's happening in today's fast-moving markets. That takes time, money, and it comes at a cost. That's why I'm suggesting you leverage off the experience of a professional property advisor, a property strategist, somebody who's independent, somebody who's unbiased. Sound professional advice is never expensive. On the other hand, most investors pay a huge learning fee to the market by buying the wrong property in the wrong location at the wrong price. Now, quick disclaimer. My team at Metropole are property investment strategists, so sure, I'm biased when I say this. But over the years, we've been involved in over $2 billion worth of property transactions. Our property management departments are currently managing over $1.5 billion worth of assets for our clients. We've all been through multiple cycles, so you're getting advice from people who've actually done it. Our job is to help our clients grow, protect and pass on their wealth. And you're going to find if you do see the team at Metropole, our advice is independent because we have no properties to sell, and with offices in Melbourne, Sydney and Brisbane, we have access to all the great properties on the market and all of those off market, or many of those off market as well.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'm going to share some lessons I learned from the late Jim Rohn, who was one of my early mentors, who taught me about the concept of personal development. I'd never thought of that before. He taught me I could have more than I've got because I can become more than I am. I guess he also taught me that unless I change, I'm not ever going to have more than I've got. One of his other lessons was, don't join the easy crowd. You won't grow. Go where the expectations and the demands to perform are high. We've spoken about this before, the importance of who you hang around with. And in one of his great lessons, Jim Rohn taught us that we face two choices in life. Each of us has two distinct choices to make about what we're going to do with our lives. The first choice is we can make it less than we've got the capacity to be, to earn less, to have less, to read less, to think less, to try less, and to discipline ourselves less. He also says, though, that these choices lead to an empty life. These are the choices that once made lead to a life of apprehension instead of a life of wondrous anticipation. Okay, so what's the second choice Jim Rohn was talking about? And that's to do it all. To become all that we possibly can be, to read all the books we can possibly read, to earn as much as we possibly can, to give and to share as much as we possibly can, to strive and produce, to accomplish as much as we possibly can. Jim Rohn taught me that all of us have got a choice, to do or not to do, to be or not to be all or to be less or to be nothing at all. Jim Rohn said, like the tree, it would be a worthy challenge for us to stretch upwards and outwards to the full measure of our capability. Jim Rohn taught me, why not do all that we can, every moment that we can, the best that we can for as long as we can? Our ultimate life objective should be to create as much as our talent and our ability and our desire will permit us to do. To settle for less than that would mean we'd be failing in the most worthy of undertakings. And so how do you measure how you're going? Jim Rohn said it's the results that are the best measure of human progress, not conversation, not explanation, not justification. So how do you know how you're going? The results. So just for a moment, be honest with yourself. How are you going? Are you happy where you are? Are you comfortable where you are in life? Are you where you hope to be? And if your results are less than your potential suggests they should be, that just means you've got to strive for more, to become more today so that you're going to be more tomorrow. Become more today than you were yesterday. The greatest rewards are always reserved for those who bring value to themselves and to the world around them. And as a result, you're going to become the sort of person you deserve to become. Some great words from Jim Rohn to live by. Now you've got two choices. Which one are you going to take? Live a life of comfort or be the best you possibly can be?
If you're enjoying our show, please subscribe on iTunes. You'll find us there as Michael Yardney Podcast, and we'd really appreciate it if you would leave us a review. When you do, we'll read it out on the show. By the way, Michael creates a lot of content he only sends out by email, which you can have with no obligation. So also visit michaelyardneypodcast.com and subscribe to his commentary there.
Hello, Ken. Welcome back to the Michael Yardney Podcast.
Hi, Michael.
Now, Ken, a couple of weeks ago, you answered Darren's question about how to set up the right structures to own properties. And I've got another question from Andrea Monk from Western Australia, possibly following on from that, because you said, can I claim negative gearing if I own my investment property in a trust? What's your answer to Andrea?
Look, great question, Andrea. But maybe just before I answer it, I'll premise the notion of negative gearing. Negative gearing is actually receiving less money, rent, than your expenses. So you're on a hiding to nothing if that's going to be a long-term plan just to get a tax benefit. As investors, we've got to be astute and smart and buy good investment-grade properties that allow us to move into positive rental territory as quickly as possible. So putting that aside, yes, you can claim negative gearing using a trust, but not all trusts. A trust are only a set of words in a document, and some trusts will allow you to claim that negative gearing against your wages. But the problem with that type of trust is the ATO wants you to then receive the positive rent when it becomes positive. They want you then to receive any capital gains if you ever sell the property. So the whole notion of the ATO letting us claim negative gearing is because we are eventually going to recoup our costs and make a profit. That's why you can claim negative gearing. I'm going to eventually make a profit and then pay tax. And the ATO lets you claim those losses like any other business. When you're starting up, if you're in a loss, you can carry them forward. So some trusts will let you do that. Others, unfortunately, will not. And that's the typical trust that people call a family trust. So if you use a family trust, which is a lot more flexible, has a lot more asset protection, has a lot more benefits, those losses would be trapped in that trust. And if you're using wages, you will still have to pay the bank, but you won't get a tax deduction.
Let's be clear, Ken, that while you use the word trapped, it doesn't mean lost, because one day when the property becomes positively geared, or you are able to distribute other money into the trust from distributions or from dividends, or if you work in a business where you can actually pass money across from one entity to another, you can take advantage of it, can't you?
Correct. So, as you've said, you will eventually get it back when it starts becoming positive, or if you sell it, the capital gains will be reduced by those accumulated losses.
I think the gold in your message, Ken, was that you don't buy property for negative gearing. And negative gearing really isn't even a property strategy in our mind.
No.
What it is a cash flow situation, a financing situation for a period of time. So a particular property is not a negative gearing or a positive geared property. If you pay 100%, don't take a loan, every property is positively geared. If you take a bigger loan, almost every property becomes negatively geared. So it's just a finance strategy that's got to be put in the mix of asset protection, ownership, passing on to the future. And it's not a simple question. There's no right answer, is there?
No, and whether you're a wage earner or a business owner, that will be a big determinant of whether you use a trust, but more importantly, what type of trust. And a lot of our business owners take the advantage of using a family trust to buy investment properties because they've set their business up in the right way to be able to, absorb what would have otherwise been trapped losses in the family trust. So particularly for business owners, I see a lot of people missing out on the opportunities to maximise, if you like, the returns and benefits of owning a property because they haven't set their business up correctly and then they don't buy their investments correctly.
So let's put a quick disclaimer in, as we have to. This is only very general advice. So if you want more specific information, see your advisor, or why not see Ken? Go to metropole.com.au, click on Wealth Advisory, and they can catch up with you that way, can't they, Ken?
Absolutely. And we'll be able to go through your specific circumstances, put in place a plan, and then help you roll that out to get the results that you're ultimately trying to achieve.
Thanks a lot. Thanks for answering Andrea's question. Look forward to having you back on the podcast again real soon, Ken.
Thank you, Michael.
Well, that's the end of this week's show. Thank you for spending the last 20 minutes with me. I've also been exhilarated by the number of great 5-star reviews we've received on iTunes. And if you're learning something from this, I'd really appreciate you leaving your review because it helps spread the message. And I've offered to read out any review that's been placed there to help shout out and say thank you. And Tyrone sent a great message saying, I'm so happy to hear that Michael's released his own podcast as I've been following him for years in magazines and his books and seen him across the media. The personal touch and information he shares is absolutely gold, and I love the mindset and mentoring that he provides in each episode. I'm enjoying hearing him share the fundamentals and talk about investment grade properties. Worth every minute spent listening to the podcast. Thanks so much, Tyrone. And Michael Hornstein left a message. Fantastic podcast, Mike. I'm new to the property market and this gives me confidence and direction on how to proceed and begin investing. Really excited for the following episodes. Thanks again, Mike. I'll be reading out the podcast reviews and I'd love you to leave one so you can hear your message read out. Look forward to catching up with you next week when we discuss some more ideas about property investment, money and success.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.